All right, welcome to another bootcamp lesson, ladies and gentlemen. Today's lesson is going to be on the topic of adapting your strategy to market conditions. So as we know, the market is always changing, right? There's always new world events happening. There's always changes in interest rates and economic factors and things of this nature. So we have to constantly be adapting. I think it was Charles Darwin or someone like that who said it is not the strongest or the smartest species who survives. It is the most adaptable that survives, and that remains entirely true in the game of trading. So let's go ahead and get into it. This is a build off of our previous lesson on what to do if your strategy stops working. Back in that lesson, we discussed all the theory of it. Now we dive into the actual actions. So what most traders do? Well, whenever market conditions all of a sudden just change or shift to different conditions, a lot of traders fail to shift from a euphoric state of mind caused by wins to a grounded mindset that accepts the slow periods of the market. So they begin to fight the market out of frustration and often give back all the winnings plus some before they realize they should have just adapted. So I see this time and time again. This may even be a pattern in your trading right now, is that you'll go on these winning streaks. You'll start to get very confident, very hyped up from this winning streak. And then as soon as the market shifts, and you have to go from hitting like a huge trade 10R with a full port stop. Now you have to shift to an environment where you're trading with a quarter of the risk that you were before. Now you have to aim for half the profit target you used to. And a lot of traders cannot make that adjustment. They simply cannot mentally shift from a euphoric mindset to a grounded / survival base hit mindset. So that is the first shift that traders fail to do, and it's a big reason why they blow their accounts when the market conditions change. The second thing traders fail to do is adapt to smaller ranges, smaller moves. Whenever the market tightens up, they keep aiming for their regular TPs and huge runners when the market is clearly refusing to offer large runs, and a lot of time it's being purposely held back from running those external or higher time frame liquidity levels. So you're not going to get the huge runs that you get to the daily or the weekly targets. You're not going to get huge 5, 6, 7, 8R moves. You'll probably just have to settle for a smaller move. So this leads to frustrating break evens, edge TPs, and what some traders will do is they'll keep aiming for the same target that they did in a large range market, and they wonder why it always comes back to break even, or they get frustrated when it doesn't run for their full target, and the whole time they could have been chipping away 1 to 2 Rs all day, still taking home some money, but instead they're frustrated and they're fighting the market and they're giving away a lot of the money. And this is something I noticed in myself, in my journal. I noticed like there seems to be times in the market where it just doesn't want to give me the 3 or 4R. And if I don't settle for a 2, what's going to keep happening is I'm either going to keep breaking even on the trade, or I'm going to keep losing because I don't take off my trade when it reaches 2R. And then instead of running for a 3, 4, 5 like it usually does, it comes back to my stop loss. So there was a period of time where I realized like, hey, if I just identify when the range gets smaller and then adapt the strategy to the smaller range, guess what? I'm no longer going to be getting fucked by the market when the conditions tighten up. And trust me, and this is a very difficult thing to actually get your ego and get your mind to do, but it is the only correct response. So if you're able to follow just these two things, you are automatically going to be ahead of 90% of traders who, even the traders who do sometimes get big payouts, they fail and give back all their payouts because of this very thing. Now, lastly, a lot of traders have a fucked tendency to scale up and risk more as they become more frustrated and confused, rather than do what makes logical sense, which is to scale down when it's not making sense. And you might have ran into this issue before as well, but this is how you do it. You do not fight an invincible opponent. You do not take that frustration and amplify it and try to throw it back at the market. You take it as a warning sign, you scale down, and you lay low and play it safe, play it cool, take your positions with half risk until it shows you that it's getting back to normal conditions. So you have to adapt, guys. Do not react and overreact and fight the market and get frustrated. Simply adapt to what it's showing you to do. And this is how you adapt your strategy to what it's doing as well. So now that we've got that understood, we have to go over strategy adaptation, which is basically how we accomplish what we just outlined. So first one, lowering expectations mentally. It is very difficult to go from hitting home runs with huge runners, huge TPs, huge RRs, to going down to taking base hits and 1 to 2 Rs with half risk. It is a very, very underwhelming shift, and your dopamine receptors are going to be fucking screaming because they were just being lit on fire through the winning streak, and now you're basically starving your dopamine receptors with these small base hits. So you have to be very aware, and you have to keep this system in check very much as you're going through this. And a quick trick for this is during these times, you have to find other natural sources of dopamine, like hitting the gym, like going for a run, like going to boxing or playing music or doing something else productive that increases dopamine, because your dopamine system will be underwhelmed during these times. That is normal. Do not worry about it. Second, lower TP and RR expectations. So like we covered in the previous slide, you want to be adapting to the smaller range of the market and more crowded PD arrays all stacked together. And these two elements equal less room for big RR trades and less room for huge runners. In these conditions, runs for external liquidity are also way less probable. So you want to be aiming for a 1R, 2R max in these environments. And it is optional to leave a runner. Honestly, I would not recommend it unless you move stop to break even when you let that runner run, but do not expect it to run like it usually does, and do not sit there and try to micromanage it. Otherwise, you might get frustrated and find yourself in more positions. Now, lastly is you want to lower the risk. So factors above can make your position deliver way choppier with way more drawdown, way more back and forth than usual, even on a valid setup. Let's say you take an IFEG entry and it usually plays out within 1 to 2 minutes or 4 or 5 minutes max. In lower probability conditions, it may take up to 30 minutes to an hour to get that same delivery, especially in really bad conditions. So factors above can also make your position deliver way choppier. It's beneficial to drop risk by at least 25% in order to hold trades more comfortably and to not be pissed off if you get wicked out or experience manual intervention. So if you do these 3 things, you will be able to still make profit even in ranging markets, even when price is shit, even in the worst conditions imaginable. You're still going to be able to at least survive, pay your bills, and make money when this happens. And the way you do that is adapting your strategy. Now let's go ahead and look at the charts here, and we can go through a few ways where this is present. So right here, for example, guys, what is this? This is just a pure consolidation. We made a huge drop and we decided to stall out and consolidate here. Now, if you're a beginner trader, this probably just looks like chop. This probably just looks like nothing you ever want to trade. And guys, there are some times where it's weeks or months where it looks exactly like this, especially if we have other economic factors at play. But what we also have to understand is the market is fractal and the algorithm is always working. So let's go ahead and test this out. Well, what do we have right here, guys? Well, let's dive deep into the chop so we can actually figure out what's going on. Well, what really happened here is we came down and we swept a level down here. What happened after that? We printed a bullish candle and we made ourselves a bearish fair value gap. From that bearish fair value gap that's still being respected, and this is obviously consolidation, chopped around for a little bit, swept a high there, went down, swept a low there, so internal range liquidity. And then what did we do? We displaced, we touched the 15-minute fair value gap, we rejected, touched it again, swept a level, we rejected, and then what happened as well? We came down here and we disrespected this order block right here, so we had that 15-minute order block right there. Ended up disrespecting it. Boom, going straight through to there. And then what did we make? We made a 15-minute bearish order block right there. So boom, we had that order block right there. You could see we have that right there. And I'm actually going to go ahead and mark these out just because we need to see exactly what's happening here. So we got that as there as well, guys. Look at that. 15-minute order block and 15-minute order block mean threshold. Then like we discussed, we had one right here too, but it failed. So we had this one here too. You could just see how fucking crowded this thing is and how messy it is. And honestly, the move on these days is to not even trade. But the whole point of this video is how to make money, even on a day where you shouldn't trade. So there are going to be times where the market tightens up. So this is a good skill to have, especially if you want to do this full time. All right. So what we got right here, we got a sweep down there. From that sweep, where do we go? We went from liquidity to imbalance. You remember those concepts? We went from imbalance to imbalance. We traded through the imbalance. We came down. We swept more liquidity. And then from that liquidity, where do we go? We went to the imbalance. Imbalance to what? Back to liquidity. Liquidity to what? Back to imbalance. Went through the imbalance, back up to this imbalance, down to what? Another imbalance. And that's that bullish fair value gap. So you can see all these concepts still work, guys. It is just a very tight range. So if you're not privy to the levels, if you haven't studied this a lot in good conditions, it's going to be very hard to see them in bad conditions because you're just used to being able to see them easily. So now what we're going to do is we're going to go and drop down into the 1 minute time frame. And the exercise here is to find out what's actually going on and how we can still make money. And you can see just the disastrousness of this price action here. This is just makes me want to throw up. Guys, look at this right here. We had that sweep down at this level, right? Boom. What could have you done from that sweep? Well, what did we have? We had a change in the state of delivery right there. That left an order block. So we had a 1 minute order block right there. So we had ourselves a 1 minute order block there. And what do we have from that 1 minute order block? Well, we deliver up into that fair value gap. So we went straight to the draw on liquidity. So there's several entries you could have took here. You could have took a turtle soup off the sweep, if that's your model. 10-point stop right there. And then right up to that fair value gap would be a nice 1 to 11. So you got a 1 to 11 right there off the turtle soup. What also do you have? You have an order block. Now on this order block, if you put it right at that low, you go up to this area, that is a 1 to 2.5. So of course this range does offer quite a few positions that are over a 2R. However, it is not in your best interest because look at how long it chops around here before it finally gives this to you. So you've been much better off just going here. And then even on this one, it does play out right here and right here, but still to get to the final target, it takes all of this chop. So even then, you want to be aiming for internal range liquidity right there, or even if you wanted to be even more safe, you could have used the midpoint of this order block right there. And you would have got there way faster, 4 or 5 minutes versus 10 plus. Now, after we reach this level right here, what happens? Well, from that level, we have a market structure shift right there. We also have a change in the state of delivery, which leaves behind a bearish order block. Doesn't touch the bearish order block, but what else did we form, guys? Well, we formed a breaker block. So right here, we have a bearish breaker block, and then we go down from there. Now, I did not teach you guys breaker blocks. I don't really use breaker blocks all that much. So honestly, in terms of my model, the only trade here would be the top tick. So that does offer you a nice top tick right there. You could have taken it back to this 1 minute order block down here for a nice 6R. And if you wanted to be really safe, you could have just took the 2R back to this order block within this range. And you can see here, it does kind of try to wick you a little bit, but ultimately it goes down. And then we consolidate for a bit. We consolidate here, and then we finally make this 15-minute order block here on the bullish side. And then what happens from here? Well, go down, we invert a fair value gap right there. And this is where you have to really adapt, guys, is in situations like this. Because even though we had that bullish IFEG on the 1 minute, if we do take this position, you could see that it doesn't really offer you the best RR. especially up to that first target. That's a 0.34. We don't reach a 1R until right there. And even if you had a tighter stop loss, like possibly under this candle, you're going to reach a 1R till right about here. So this position didn't even give you a 1R before it started to go the other way, guys, and it wouldn't have gave you a chance to not get stopped out at break even. In this case, this is an example where you have to be very nimble and not try to aim outside of where price is being held. So that position wouldn't have gave you the 1-to-1, but you used half risk, so it's okay. You still didn't take that much damage. So that's also why you have to risk less, because you'll see good setups not fully play out. Now, you could have taken the turtle soup down here potentially. You had just enough stop loss to not get wicked out, and it still would have ended up playing out pretty decently for a nice 5R. But even then, look at how much chop it gives you. Look at how much indecision it gives you, guys. And if you tried to move your stop to break even here, would have came back and broke you out even. What was that? A 3R maybe? Almost a 3R. But usually that would run for a 3R right off the bat. So even the turtle soup model, it plays out even more choppily in these environments. But you can see if you time it right, you can still make some money. Now from there, what else do we offer? Well, after this long fails, we actually get an IFEG to the downside. So right here, you can see price inverts that fair value gap there. You could have entered after that, and it makes a 2022 model. We shift structure there, fair value gap. So you could have entered there as well. And then I think both of these entries were pretty solid. So you could have had that entry there, aim for a nice 1-to-1, 0.6 right there. That would have been first target. You can target that second one to a 2.4R. And then if you got in on the actual 2022 model, that would be your risk to reward there. So not too bad actually, but you can see just how choppy it still plays out. So even then you still want to be using half risk. Of course, the RR is a lot less too if you took the IFEG model versus the 2022 in this particular example, but nonetheless still delivers a trade. Now, we also have this one right here after we sweep that low. So we swept that low, invert a fair value gap right here. We also have a change in the state of delivery right there. Does not respect the order block, but it does respect the IFEG. But even then, guys, like I said, it does have a tendency to go back very quickly. So after we reach up for that 15-minute order block again for a 1-to-1, we end up going back, and you'd probably be stopped out at break even. So that's an example where the range is a lot smaller. And then you can see after that, we come down here, invert another fair value gap, and then we eventually find ourselves back up in that fair value gap on the bearish side. And then after that, we even come down into here, into this 15-minute gap, invert a fair value gap. But you can also see does not offer the best risk to reward there. So right back up to that gap is about a 1-to-1. And then it kind of just chops around for a bit as well. So in these environments, guys, you can see that you still can make plenty of money. There's still plenty of setups, but they're just far harder to identify, and it's far harder to predict when it's actually going to run for any type of external target. And the challenging part is we have a fair value gap up here. We're technically in a discount, so it makes sense for us to retrace to a premium, but whenever we're consolidating, it does not have to leave, guys. Just because this is up there does not mean it has to touch it. It could avoid it for days if they really want to hold the market. And that's how they trick you. They make you think it's going up there just to bring it back. And that is why you also have to aim for lower risk to reward. But honestly, guys, this is everything that no guru is going to show you. No guru is going to go into this because they don't actually fucking trade year round. They don't actually know how to adapt, because when their strategy stops working, they just start selling you guys fucking courses. So don't shoot the messenger, but that is exactly what's happening. That's why no one's broken this down to you. So I am here right now breaking this down for you so you guys can actually trade full time and not wonder if my strategy stopped working or if the market stopped pricing the way that it always will price. Comment down below what you think of this lesson, guys. Comment what you learned, and also comment down below day 28 complete. We are almost at the finish line, guys. So congratulations to all of you who made it this far. So I'll see you in the next lesson. Have a blessed night, everybody, and take care.